Thank you for joining us for this week's episode of the Apartment Academy, the multifamily industry's only operations-focused podcast and your institute of higher NOI. I'm your host, the Dean of the Apartment Academy, Daniel Cunningham, and today's guest lecturer is Mark Gardella. Mark is CEO and co-founder of Sertis Insurance. If I say the word insurance, normally I think people start going to sleep, but right now, in what has been happening the last couple of years in our industry is unprecedented, truly, in terms of the increase in rates and its impact upon multifamily operations. If you are seeking a solution to reduce your insurance costs or control the increases and find an alternative way to save money on insurance, today's podcast is going to be a godsend for you. So let's not waste any time. Let's bring on Professor Gardella. Welcome, Professor Gardella, to the Apartment Academy. Where do we find you today?
I'm in beautiful Reno, Nevada.
Awesome. Wonderful. Thank you for taking the time to join us. Mark, you guys are doing something very interesting in the multifamily space. Your company, Sertis, you're president and CEO of Sertis. And we want to get right into that. Before we start, though, do you want to talk a little bit about kind of your background? How did you come to get involved in multifamily? What's your background that led you here?
Yeah, absolutely. So I'm a 25-year veteran of commercial insurance, almost that entire time spent with insurance companies, the likes of Zurich, AIG, Markel. And most of that time, I was really focused on what are called the MGA space, which is outsourced underwriting to specialized insurance agency. I think we'll talk a little bit about that, but that gave me a grounding of how this market works in really specialized insurance. Towards the latter part of my carrier career, I saw money being invested into the insurance space around startups, and I absolutely wanted to jump into that because I saw working with large companies how difficult it was to bring innovation to the table, leveraging data because they were all in silos and the bureaucracy that was tied to it. And it was frustrating. It was like pushing that rock up the hill and having it roll back down. That's when I went to Markel when I joined their innovation team and ultimately head of open innovation, sat on their investment committee and just saw just the incredible work that was being done and how the industry was going to change. And it was at that point that I really wanted to actually get my hands dirty. And that's when I stepped out to do consulting and start working with the startups. And that's how I ended up actually with Sertis.
And let's start by this. The Sertis story starts with kind of what's happening in the industry right now on the insurance side. Not resident insurance, not like lease law kind of stuff, but we're talking like property casualty insurance rates. Talk about like what is happening there because it's crazy.
Yeah, for anybody who's on this listening to this podcast, I suspect they're feeling the pain as we speak. The National Multifamily Housing Council just released an annual report that talks about the increases in rates. And in that report, it actually says the average rate increased 23% just last year. And rates have increased 22 quarters in a row consecutively. And what that's doing is really, it's amazing. It is having a material impact, not just on the profitability, but it's actually started to impact where developers, where owner operators are going to build, if they're going to build, if they can sell a property or if they can buy a property. And it has so many impacts from bank covenants to just overall business decisions on how they grow their business. So we recognize clearly that there's a massive challenge that the industry is facing. And quite frankly, on the insurance side, there are very few carriers that are actually willing to come in and try and address this space. Most are running, quite frankly.
So just give the listeners some scope of what that means. For example, I remember, Mark, when I was running a management company, I guess I stopped doing about 8 years ago, combined property and casualty rates were somewhere around $150 to $250 a unit a year, in that range. That's what we used for budgeting purposes. It would vary from what part of the country you're in for sure. What have they grown to now?
Yeah. So we were having a conversation with a developer, with a fund that takes and acquires properties, puts in money, dresses them up, and then flips them anywhere hold time in between 1 to 7 years. And they were telling us about a property they had built that they had bought in Dallas, and I want to say it was about 2.5 years ago. At that time, the cost was somewhere around $600 to $500 per unit for the property and the general liability. And they just got hit with a renewal of $1,500. Now, 3-time increase. If you think about that, that's taking up potentially an entire month's worth of rent just to insure. What does that have on the impact of the overall portfolio's return when you have that level of rate increases? It's catastrophic in many cases.
That is insane. Why is this happening?
Yeah, great question. I'll give one other example because I think if you think about Florida, you're now starting to see some of these rates go anywhere from $2,500 to $3,000 and more per unit. So it's just, in some places, it's almost become, you're not able to actually buy the insurance because you can't afford it. Now, there are really 3 reasons why this is happening. The first one is catastrophic. We're talking about Florida. Catastrophic loss. Those are the hurricanes, the floods, the hail, wildfire, all impacting. It's happening. The frequency and the severity of these are happening faster and harder than the industry expects. In fact, just this first half of the year, the insurance industry here in the United States absorbed $42 billion worth of cat losses. Now, that's the first piece. The second piece is inflation, which we're all feeling today. And it's simply, what does it cost to build something new or repair something that's already been damaged? Between labor and the construction costs, we've seen some of those material costs come down a little bit from the height, but you're not going to see the labor costs come down anytime soon. The third reason is one that's not as well known, and that's what within the insurance industry we're calling it social inflation, and that is the frequency of large judgments. So a slip, trip, and fall, which may have cost $25,000 to help somebody with medical bills, now could be $250,000, $750,000. Once there's lawyers involved, it goes up exponentially. And I'm not sure if anybody saw a couple weeks ago, 60 Minutes did an entire piece on law firms and hedge funds who are funding these kinds of lawsuits. So we don't see that changing anytime soon in terms of the social inflation and the impact that is. And that's why you're seeing a lot of carriers, quite frankly, leave and show an unwillingness to even write multifamily now, which leaves so few players, and that's where the rate increases are going up.
You say carriers actually leaving, just not even underwriting multifamily anymore, or just leaving certain states? Just period, leaving the industry?
In some cases, I mean, Florida is the classic example that everybody's running for the hills. In Florida, no one wants to write in Florida because there's just no capacity to do it, and they're not sure that they could ever make money. But it's impacting the entire country because inflation's hitting the entire country. You're still getting catastrophic losses like flood, and up in the northeast, flooding is a perfect example that's happening right now. It's just happening more frequently. And that social inflation, yes, it's jurisdiction. There's an element of jurisdiction where it's more prevalent than others, but it's happening across the country. So we are not seeing really an end to this increase in rates, quite frankly.
That's interesting, Mark, because I get the catastrophic. I mean, I understand people aren't going to insure in Florida, maybe parts of Texas. But I think about my property in Arizona, like, well, what we do wrong? Why does a state like Arizona get punished? And I guess that's a combination. I guess the social inflation is what's driving that. And if people are leaving the business, there's just less competition, perhaps.
There's less competition, so invariably the rates are going to go up. Yeah, you're probably going to have a better chance of getting a more stable rate in Arizona than if you're in southern Texas or Florida or Louisiana, but you're still having a lot of these impacts, both from an inflation standpoint and the social inflation that are impacting it.
Have have the underwriting guidelines gotten tougher? Like, are there scenarios now where even in a decent state that's not affected by catastrophic losses that you maybe can't get insurance if you don't meet a certain criteria?
Yeah, and I think some of the challenges around crime, gun violence, and things like that are now having impacts for multifamily, where we're seeing an increase in shootings or emerging trends that are associated with crime that we never really had to contemplate. Trafficking, sex trafficking has now become an emerging issue that we've seen multifamily operators actually be sued for things that the residents did or may not have done. So there's just so many moving parts, and it just has a tendency to scare a lot of the more traditional carriers.
That's interesting. How are carriers making that crime judgment? How are they figuring that part out?
Well, they're certainly there. What I would tell you is there's certainly crime scores that underwriters, those are the people who select risk and price risk, have used. Sometimes there's a level of biases that goes in. Every human has biases when they go into it. If an underwriter had a claim tied to a certain sort of in a certain location, they're going to have a tendency to feel fearful of that town. But there are more emerging crime, more sophisticated crime scores and ways to think about underwriting that are emerging. You just need an underwriter who has conviction to say, I can start to discern a good operator from a bad operator. And it's tough, quite frankly, with the decision points and the data that a typical underwriter would see. It's really difficult for them to make that distinction.
So, Mark, there's no end in sight. You expect this same trend to continue. We're in 2023 now, 2024, 2025. The increases are going to continue?
Unfortunately, I think that is the case, because what you need is somebody to come in and recognize that there's a different way to do it. Right now, none of the insurance carriers that are currently in the space or outside see a way to make profit. So there are no new entrants coming in. But that's until now, that's where Sertis comes in, because we have a strong thesis that there's a better way to approach and think about risk selection and pricing for the owner operator.
And they don't think there's a way to make money in multifamily because, I mean, even they're charging these exorbitant rates. Why can't they make money in multifamily? What's different about us?
So it's a combination of a number of different things. But if you think about multifamily apartment complexes, you have so many different exposures that are tied to it. Most of the growth in the industry is happening where catastrophic losses happen. You have people living in close proximity, 24 hours a day, people coming in and out, children. It's just it's a whole list and pile of things that could go wrong and could be scary. So how do you price for that? So if inflation's impacting pricing, if the catastrophic losses are impacting it, and the social inflation, there's just no perceived incentive for a new entrant to come in unless something changes.
And yet, here comes Sertis. Like, what? So you guys are just getting into the market. Given everything you just mentioned, what is it that Sertis is doing that's different, better? Like, why are you doing this?
Yeah, so great question. So traditionally, how underwriters had made risk selection and pricing decisions really stemmed off of really three different documents. The application, which the insurance broker would send in, which had about 50 questions. a thing called the SOV, Statement of Values, which is a spreadsheet of nothing but the property attributes of the buildings that are being insured. And then a loss run, which shows historical losses. So all of the decisions that people are insuring today are based off of a snapshot in time, and most of it is historical data. And by the way, a good portion of this may not even be correct. So the foundation for which these underwriting and pricing decisions are being made are not reflective of what the operation is happening today and going forward. And that's where Sertis comes in, because our thesis is that we want to identify and reward good operators. And what I mean by good operators, it's those operators, owner-operators, who are being proactive about how they maintain their property. And we're able to document how that performance, how they are mapping it, or taking care of those properties throughout the year, giving us a real good visibility into how that property has been managed. And then we can provide a feedback loop to the owner operators through their brokers on how they can continue to keep that property well. What does that empower us to do is actually make better terms and conditions for that owner operator. Why? Because they're doing the right thing, and we can see that they're doing the right thing, and we see a partner in that owner operator and their broker in reducing risk and avoiding claims. Ultimately, lower claims gives us the power to be able to give better pricing.
So the past paradigm was you had some data that was being provided, physical attributes of the property. We talk about SOV, the statement of values. It's things like, do you have aluminum wiring? When was your roof replaced? I remember going through the days of trying to gather all this data together at the last second to send it off to the broker. And we didn't care about it that much at the time, because we're like, it's, insurance is an afterthought. But the culmination of that was, I guess, years of bad data, old data, that was not reflecting or putting the property perhaps in its best light. I think that's one thing I heard you saying. But then this other concept you talked about, can you explain more? Like, what do you mean telling good operators from bad operators, the measures that mitigate risk? How does that figuring in? I mean, I've had in the past, like I remember getting insurance, they would ask me, like, do you have a risk management plan? And we would show them the risk management plan. Is it something along those lines?
As an underwriter, I used to get those apps, and every broker with their client would go, do you have a risk management plan in place? Check. Yes, of course. No one on the planet is going to say no. Now, what are the odds that everybody has a risk management plan in place? A lot less. And what are the odds that those owner operators are using it consistently across their portfolio? Even less. But I still got the yes, you have it. So the basis for which they make the decision isn't grounded necessarily in fact. So the way to change that paradigm is really in partnership in identifying those owner operators who recognize, hey, insurance is a major input into my expense and impacts my profitability. I can either choose just to ignore it and take the rate increases that are coming, or I'm going to be proactive and actually go in and say, the maintenance of my properties is important. It has impact not just on the cost to replace something when it breaks down, but actually the cost, the potential for a profitable portfolio over time. And that's where our thesis is how do we work and partner with those owner operators to be able to put in best practices and be able to monitor that progress throughout the year. And that's where Leonardo 24/7 comes in as our strategic partner, because that's the perfect platform to be able to actually give us that visibility into how those owner operators are maintaining it, and empowers us, quite frankly, to be able to reward them through better terms and conditions.
What are some of the things you're talking about when you're talking about maintenance, things that reduce risk? Can you give us some examples of the sort of things that move the needle on the loss reduction side? Like, what should people be doing?
Basic. I mean, it's all the things that every owner operator wants being done on the ground. They want to understand if there's potentially a roof failure where there's going to be water intrusion, because if water intrusion, which is by the way about 32% of all property losses for multifamily, if you have a roof that fails and it drains down into the units below, you could have 2, 3, 4 units that are out of commission for a month or two because you're having a tough time finding anybody to actually do the work. So if you're inspecting roofs on a regular basis and you're actually being proactive in taking care of that roof, your losses are going to go down. I'll give you another example. As you're having a maintenance person walking the ground, if you have a structured way of asking the questions that need to be asked and noting where there are differences, like there's lights out in the parking lot. If you take care of all your lights, the likelihood of a crime happening in that parking lot goes down. If you're checking every day that the pool gate automatically closes, the chances of a little one going in and falling into the pool go down. It's those kinds of disciplined, consistent operational best practices and behaviors that are ultimately going to lower the frequency, the chance of a claim happening. And if a claim happens, it's gonna be smaller. And I'll give you one other example, which is really great, really interesting about our model and our partnership with Leonardo 24/7 is if there is a claim through an incident report, we actually can get that ahead of time. We see that happening, and then we can bring our claims adjuster in to actually see what was done to prevent that claim in the back. And I'll give you an example. So up in Minnesota, snow falls all the time. If you have a snow log that shows you cleaned it off at 5 o'clock in the afternoon, put down salt, somebody slips at 5:05. You can go back and actually see the pictures, see that log, and know what was done. That adjuster can say, okay, maybe this wasn't a real slip, trip, and fall. But if it was a half an hour later, maybe you sit back and say, okay, as an adjuster, they go, okay, this was a legitimate claim. Let's pay this as quickly as possible before an attorney gets involved. That's a way of mitigating or stopping a claim from ever happening.
Okay, so the things you're talking about, like the log, the incident reports, the maintenance, these are things being performed in Leonardo 24/7. That's kind of what that platform is for. They're doing that work there. How does that translate over to Sertis? How do you guys, monitor that stuff's really happening?
Yeah, that's a great question. What we've done is we've developed the first of its kind FICO-like score that really gauges and quantifies the likelihood of a claim. And what I mean by that is we're taking in all the data points from all the activities that are happening on the ground and pulling that into our model, and through weightings saying some things are more important than others, we're able to actually develop a score that shows that owner operator down to a property level how their properties are being managed, and they can get a good sense of what does that mean to their pricing of their insurance. You have a higher score, the likelihood we're going to be able to give you better terms and conditions, and we'll be able to do that with confidence because we know the work is being done.
Got it. So all the data points you're bringing in with the inspections that are being done, the logs that are being completed, that's bubbling up to. FICO score is a great analogy because I think about my credit behavior. Like, oh, I paid this on time. This one I'm late on. This one I'm maxed out. My credit is maxed out on this card. That all figures into some score that gives, the credit companies an at-a-glance understanding of how I stand as a credit risk. This is producing an at-a-glance understanding of the risk an individual property is at to a loss based on behavior. Is that about right?
Absolutely. It literally goes into our pricing model. So it's how your team was taking care of those properties directly reflects in the pricing. It's no different than like a progressive telematics that knows how far you've driven, how you drive, how hard you brake, and your price for insurance adjusts over that. That's sort of the premise that we're using, only in a much more complex risk, multifamily.
So that would imply that I guess there are bad operators that don't do these things that I guess they can't be on the Sertis platform.
We welcome everybody that's willing to commit to proactively developing their, if we can help them and it's within our appetite of what we're looking for, we want to encourage, we want the industry to get better for safer properties, for a more profitable industry, but there has to be a commitment. And that commitment starts with putting in best practices across your entire portfolio and using somebody like Leonardo 24/7 to actually be able to monitor. And it's not just for the insurance companies and the underwriters, but frankly, it's for the owner operators so they can get visibility into their portfolio and how it's performing. It's about getting data and insights into the stakeholders' hands so that they can make the best decisions possible. And I personally think this is the only way that we're going to be able to bring price stability to the multifamily space.
Yeah. Yeah, it totally makes sense. You just mentioned something I want to touch on, which is that you said we have an appetite for. What does Sertis have an appetite for? There sounds some things are not. You don't want those on. You want some things not on your plate. It sounds like.
Yeah, certainly. There's certainly things that we're interested in writing and things that we feel are a little more problematic. But in broad sense, we're really looking for professionally managed multifamily operators, and that's somebody who has a full-time maintenance person on property and generally pretty sophisticated, all the way up to some of the larger operators that are out there. From a jurisdiction standpoint, we talked about cat exposed in the hurricanes and hail and tornadoes. My first year, when we're just coming into market, we're just accepting applications, is I don't want my program to be blown out by a massive hurricane in the first year. So we're going into 15 states, including DC. It's generally on the western side of the country. We're in a little bit of the Midwest and then in the central Atlantic area. But we have designs in 2023 and 24 to get us to almost the entire country. There's some areas that are a little touchy, but that gives us the latitude to really address some of the best operators out there.
So maybe not Florida right away.
Maybe not Florida right away. That is a big problem. It's not world peace, but it's up there in solving.
Can people split their portfolio? They got some that are in states that Sertis covers, some that is that possible? I used to remember my broker was like, "Nah, we just submit them all at once."
Yeah, it's actually the market, and this is I've never seen this in my 25-year career, but it's happening every day. Is some of the largest brokers and some of the most sophisticated brokers are actually struggling to be able to place everything with one carrier, that they're breaking these portfolios up into smaller chunks and submitting them to regional brokers. And in some cases to direct writers, which were never intended to write this kind of exposure, but it's happening today. And it's quite frankly, it's a signal to the marketplace of just how disrupted and challenged multifamily is. And we see this as actually a great opportunity for those owner operators that say, hey, I've got properties that are sitting in Arizona, Nevada, Oregon, and then in Texas. Texas is a challenge. Let's put everything with Sertis. We're going to get the ground running. When Sertis is up and running in Texas, we'll move everything over. So we're seeing that opportunity. We're having those conversations as we speak with the brokers.
So is Sertis replacing my broker? Do we go to you for insurance now?
No, we see the broker as absolutely critical to the relationship, because the types of accounts that we're looking at, these are middle market to large accounts, and that broker is actually acting as the de facto risk manager. So we don't want to remove that expertise and that commitment to the client. We want to work with them and empower them to be able to help their clients make better decisions and more informed decisions. So we have no design in going direct to owner operators. We want to work with their brokers.
And so all brokers have access to Sertis? Mark, you mentioned earlier, you touched on the idea of an MGA. Do all brokers have access to an MGA, or is it something special they have to, I don't know, apply for? I don't know how.
So there is an appointment process. Really what we're looking for are brokers who have an understanding of the business, ideally, and have accounts in their portfolio. But that shouldn't stop us from being able to work with those who want to grow their book of business. So we are an open brokerage. We're going to certainly focus on the brokers who have a lot of great business that want to partner with us. But we want to be able to see the business and work with those who have the same convictions that we do, that we can change multifamily if we just change how we're working together in terms of being proactive versus let's just find the cheapest rate at all costs. Well, those days are done. Now we all need to work together to make these better risks.
With the caveat that they use Leonardo 24/7, which is there's a lot, clients that are on Leo do a lot of things with Leo. Is this a big lift to get Sertis onboarded if they need to be using Leo?
So actually, we've done a lot of thought around that because we wanted to remove the barriers to that. You're absolutely right. To be able to get into our program, you have to commit to deploying and continuously using Leo. How else would I be able to get the data that feeds my live risk indicator, that FICO-like score, is if I don't have that. So that is centerstone of the strategic relationship. Well, no, I was just about to say that it's critically important how we mitigate the challenges around, remove the barriers to being able to bring on Leo. First, cost. We recognize that having a software solution in place costs money, and at a time when your margins are being squeezed, that can be a barrier to making a good decision. So what we've done is, because any owner operator who says, yes, I want to deploy, or who already has Leo clients, we absolutely want to work because you've already made that decision. But anybody who comes in to our insurance program, makes that commitment or has it, we're going to give a discount that is going to offset the cost of Leo. So the cost shouldn't be a barrier. Now, in terms of onboarding, we have a series of inspections and preventative that we know are best practices that we'll ask to be installed, but they're the things that good owner operators are doing anyway. And that because we have that list, it can take as little as a day or two to be able to have that installed. And we use videos and training to be able to bring your folks up to speed. So we remove that friction to coming on board so you can benefit from the good terms and conditions and that commitment to being proactive.
This is a good point worth double clicking on, I think, is that the things that Sertis is asking their operators to do, to demonstrate, to earn a good live risk indicator score, they're things that they should be doing anyway. You're not asking them to do anything different really than what good operators should be doing. Look, maybe some of them are bad operators and they don't do these things, but it shouldn't feel like a burden. It shouldn't feel like these are a whole new spate of inspections and things that now they've got to do for their insurance company. These are things they should have been doing anyway, I think is the point I wanted to make again, right?
Yeah, and it's with Leonardo 24/7, what you do is that owner operator actually has view into their entire portfolio and how it's being managed. So they can see where properties are doing all the great things and where there's some that maybe need some help. So having that consistent view across an entire portfolio and knowing those best practices are being followed is exactly the kind of customer client that Sertis wants. And that's why I think this strategic partnership is so important, because you give us the platform to be able to have the insights and deliver the best practices, and we can drive and take that insights to help everybody in the ecosystem.
So from a pricing standpoint, you mentioned that out of the gate, the discount that they get through the rating discount you give them, it covers the cost of the software. Roughly, is there any? I don't know that you can put a number on this, but outside of that, are Sertis's rates better, more competitive, as competitive, in some cases higher? I don't know. How will you compare to the rates that I'm getting right now, exclusive of the discount I might get that pays for Leonardo 24/7? How do your rates compete?
Yeah, great question. We have the flexibility to be as competitive as anybody in the marketplace, and we built our program and our pricing methodology based on that. Why? Because we are underwriting individual accounts on their own merit, and if it's a good operator, we're going to do everything we can to be able to deliver a good competitive quote that's going to be compelling. Because over time, what we are looking to do is actually drive and hold on to those customers and continue to reward them over time.
Okay, well, I mean, Mark, this sounds like a pretty amazing solution at a time when the industry is really desperately seeking an answer to these rising insurance costs. If somebody wants you to consider their properties for insurance, how do they reach you? Do they go to their broker? Do they reach out to you? What happens now?
Yeah, what I would suggest is go to our website, sertisins.com, and hit the contact me. And what we're looking to do is is start the conversation with your broker. A warm introduction can happen, or simply sending us the name of your broker, and we can go and start to have that conversation and start to plan for when your submissions come up. We can take a look and look to provide a quote. We're eager to see new business, so let's start that conversation.
And how far in advance of kind of a renewal period is it ideally should people reach out to Sertis?
An interesting function of this marketplace is, and if you talk to your broker, they're going to tell you this, that they are struggling to get quotes until the last minute. And then it's typically really bad news. I've heard this time and time again recently. We're looking to do something a little bit different. We want to work out as far as your broker and as far as you want, helping to make sure that we get the right data in. We'll give you a good, quick indication. Hey, this is a good fit for us, or this isn't. And if it's a good fit, we're going to look to give you an indication of what that pricing is, so you can make those decisions. We want to change the paradigm that's happening in the marketplace right now, where you're waiting until the 11th hour to get bad news. So I would say we can go out as far as 60 days.
And they don't need to already be Leonardo 24/7 clients. They commit to becoming clients alongside their insurance quote, and then you can go ahead and get them started.
Absolutely. Yeah. In fact, we welcome that opportunity because, one, we think that we're helping the entire industry in instilling some of the best practices. It's only going to be it's going to be good for the industry, and it's something that needs to happen, quite frankly.
Mark, congratulations! Great concept. Sounds like a great company, and certainly is timely. I hope as many listeners as possible take advantage of what you guys are offering, and at least reach out to see if they're in one of the covered states, if they meet your current appetite, and hopefully save a bunch of money next year on their insurance. Appreciate you coming on. Thanks, Mark.
Daniel, thank you so much for having us. This was great. I enjoyed the conversation.
Thank you for joining us at this week's episode of the Apartment Academy podcast. The Apartment Academy is a production of Leonardo 24/7, the industry's leader in multifamily operations and maintenance software. At Apartment Academy, we realize the hard work that goes into property management and the stress that comes along with it. Leonardo 24/7 takes the guesswork out of your team's day-to-day by providing customized daily guidance on tasks that need to be done, guaranteeing consistent operations across your entire portfolio. To learn more, visit www.leonardo247.com today.